Welcome to the Coastal Lowcountry Real Estate Channel. Over the last 8 years, we've seen a remarkable shift in the real estate market. We've seen market trends that generally take decades to evolve, compressed into a very short period of time. We've shifted from a market with limited inventory to a once-in-a-lifetime, hypercharged seller's market to a gradual cooling. Today, we're in a market that resembles a buyer's strike, as buyers elect to stay on the sidelines and live in their existing homes or apartments. And sellers are reducing prices just to move their homes. What happened to the real estate market in those 8 years? Well, if you're ready, today we are going to explore who killed the market.
Welcome to the Georgia-South Carolina Lowcountry. We're Keith and Donna Hellman, hosts of the Coastal Lowcountry Real Estate Channel and local realtors with Keller Williams. Do you want to know everything there is to know about living in the Lowcountry? Whether it's Savannah, Georgia, Hilton Head, South Carolina, Bluffton, South Carolina, or the surrounding areas? Well, then subscribe below and tap the bell for notifications so that you'll be the first to know what's going on in our market.
And we receive calls, emails, and texts every day from folks just like you looking to move to Hilton Head, Bluffton, and Savannah areas, and we absolutely love serving you.
So whether you're looking to move in the next week, the next month, or the next year, shoot us a text, send us an email, give us a call, or schedule a Zoom call, all in the description below, so that we can help make your move to the Lowcountry a smooth one. Hey, let's get started.
Over the past 8 years, the real estate market has experienced significant changes that were influenced by a variety of factors, including economic shifts, technological advances, changing demographics, and evolving consumer preferences. These changes have impacted housing affordability, market dynamics, and the way real estate transactions are conducted. Today we will explore key trends and transformations in the real estate market from around 2016 to 2024 and provide insight on how these developments have reshaped the industry. One of the most notable trends in the real estate market over the past 8 years has been the consistent rise in home prices. Since 2016, housing prices in many parts of the United States and other countries have seen substantial increases. Several factors have contributed to this trend, such as lower interest rates. First and most important was the presence of lower mortgage rates. For the first half of this period, the Federal Reserve and central banks maintained historically low interest rates, making borrowing cheaper and fueling demand for home purchases. From 2016 to 2021, mortgage rates hovered between just under 3% to 5%. The lower cost mortgages made home ownership accessible to more people, increasing competition and driving up prices. According to the Federal Reserve, the median home price at the end of 2022 was $443,000, while at the beginning of 2016, it was just $303,000. That's a 46% increase, or about 6.5% a year. Beginning in 2022, the Federal Reserve began increasing interest rates to combat inflation coming out of the COVID pandemic. The Federal Reserve's interest rate hikes between March 2022 and July 2023 were the fastest in 40 years. The Fed raised the federal funds rate by 5.25 percentage points during this period, increasing from a rate of near zero to 5.25%. Again, the Fed's actions were in response to high inflation, which peaked at about 6.5% in 2022, the highest it had been since 1981. Accordingly, mortgage rates doubled from about 3.5% to almost 8%. When interest rates rise, the cost of obtaining a mortgage increases. Higher interest rates mean higher monthly payments for home buyers, which can significantly reduce the number of people who can qualify for a home. Conversely, when interest rates are low, mortgages are more affordable, leading to an increase in demand for homes. Additionally, investors often rely on borrowing to finance their real estate investments. Higher interest rates reduce the potential return on investment, making real estate less attractive compared to other investment opportunities. This can lead to a slowdown in property purchases, especially in commercial real estate sector. As a result of higher interest rates, since 2022, the median home price has depreciated or basically flatlined to $412,000. Just last week, the Fed cut its interest rate by a half percentage point to 4.75% just in time for the upcoming election. we'll see what impact that has on the housing market. Another trend leading to the substantial increase in home prices is a shortage of available homes, particularly in desirable urban and suburban areas. This shortage is partly due to the lack of new construction and zoning regulations that have constrained the ability to build new homes. Coming out of the financial recession of 2008, there is a significant oversupply of housing. This was as a result of homes and builders being foreclosed on during this time of financial stress. As a result, construction of new homes crawled to a halt as demand drastically dropped off and the construction labor force redeployed into other occupations to make ends meet. As a result of this hangover from the Great Recession, home construction never caught up with once demand returned. Demand for housing also started to surge as millennials, the largest generation in history, entered their prime home buying years. The pandemic further accelerated demand, with people seeking more space for remote work and family life. Realtor.com estimates that there needs to be 7.2 million single-family homes constructed today in order to meet current demand. If you factor in multi-family homes such as apartments, that gap narrows to 2.5 million, but that is still a significant shortage. The result of these factors has been a market where home prices have risen faster than incomes, creating a significant affordability challenge for many potential buyers, especially first-time home buyers. In some cities, housing affordability has become a major issue, with a growing gap between wages and home prices. Lack of affordable housing has led buyers to currently go on strike and flee the housing market. Interest rates are beginning to fall and builders are ramping up construction in recent years, but there is still a long way to go before home ownership is affordable.
Hi folks, we're trying to get to 2,000 subscribers, and if you like our videos, you know what to do. Please subscribe below.
Another event that profoundly impacted the real estate market was the COVID-19 pandemic. Initial expectations when the pandemic began was for there to be a significant downturn. Instead, the market experienced a surprising boom in many areas. The pandemic led to a widespread shift in remote work, changing what people wanted in a home. Many sought larger homes with a space for a home office, a yard, or proximity to nature, driving demand in suburban and rural areas. Cities that were previously in high demand saw some softening, while smaller cities and towns experienced a surge in interest. The pandemic also disrupted global supply chains, leading to a shortage of building materials and labor. This caused delays in new construction and contributed to an already limited supply of homes on the market. As mentioned previously, migration trends have shifted, with people moving from high-cost, densely populated urban areas to more affordable and spacious suburban and rural regions. This trend was amplified by the pandemic and the rise of remote work, leading to an increased demand in areas that previously saw less market activity. Demographic changes also played a significant role in shaping the real estate market over the last 8 years. As mentioned previously, millennials, the largest generational group, have entered the housing market in significant numbers. Unlike previous generations, many millennials delayed home ownership due to factors like student loan debt, high living costs, and lifestyle preferences. However, as they age, marry, and start families, their impact on the market has become more pronounced. Millennials tend to prioritize features like walkability, access to amenities, and environmentally sustainable homes. The aging baby boomer generation has also influenced the market in various ways. Many boomers are downsizing or moving to retirement-friendly locations, impacting the demand for different types of housing. The need for accessible single-story homes or properties in active adult communities has increased. However, a point to note was the significant bottleneck in home supply that was created when baby boomers refused to downsize because of the higher interest rates. Many boomers did not want to trade their 3% mortgages for a 7% mortgage, and instead elected to age in place. Again, with the recent reduction in interest rates, perhaps this trend will begin to reverse. Government policies and regulations have also influenced the real estate market. In response to rising home prices and affordability challenges, some governments have introduced measures to increase housing supply and affordability. These include zoning reforms, incentives for affordable housing development, and rent control measures in certain markets. An interesting example, in a recent article in the Business Insider entitled "The U.S. Drinking Age Law Could Be a Model for Fixing the Housing Crisis," Eliza Relman explores the idea of using federal incentives to encourage states to address housing shortages, much like the federal government influenced state drinking age laws in the 1980s. The argument is that the federal government could withhold certain funds or offer financial incentives to states that enact zoning reforms or build more housing. This approach could help alleviate the housing crisis by promoting a more coordinated and creative national housing policy solution. Other government initiatives include, following the 2008 financial crisis, mortgage lending standards were tightened to prevent risky lending practices. However, over the last 8 years, there have been discussions and policy changes aimed at balancing access to credit with financial stability. Programs like FHA loans and first-time homebuyer assistance have continued to support market participation. During the 2019 COVID pandemic, governments introduced various relief measures to stabilize the housing market, such as mortgage forbearance programs and eviction moratoriums. These interventions helped prevent a wave of foreclosures and provided temporary relief to homeowners and renters facing financial difficulties. As a result of the above, the real estate market is now showing signs of moving towards a more balanced state after years of rapid price appreciation and intense competition. Concerns about inflation and an overheating market have led central banks to implement gradual increases in interest rates. This has cooled the market and curbed unsustainable price growth. Also, efforts to address the housing supply shortage have started to bear fruit in some regions. Governments and developers are working to increase the availability of affordable housing and ease zoning restrictions to encourage new construction. The extraordinary market conditions caused by the pandemic are beginning to normalize as the world adapts to a post-pandemic reality. While demand remains strong, it's becoming more measured and inventory levels are slowly increasing. The real estate market has undergone significant changes over the past 8 years, shaped by economic conditions, technological advancements, demographic shifts, and regulatory interventions. Rising home prices and affordability challenges have been persistent themes, driven by low interest rates, limited supply, and changing consumer preferences. The COVID-19 pandemic introduced new dynamics, accelerating trends like remote work and digital transactions while prompting government interventions to stabilize the market. We don't want to sound all doom and gloom here. Looking forward, the market appears to be moving toward a more balanced state with moderated interest rates, increased housing supply, and a gradual return to pre-pandemic conditions. However, challenges such as housing affordability and demographic shifts will continue to influence the market in the years to come. Understanding these trends and their implications is crucial for buyers, sellers, investors, and policymakers navigating the evolving landscape of real estate. Well, that's a wrap. As you can see, there are several factors we need to consider when trying to answer the question, who killed the market? We hope you've enjoyed our time together today. Thank you so much for staying with us to the end of the video. We also hope that you found this helpful and maybe even learned something new. If you want to stay up to date on the latest of what's happening in the Georgia, South Carolina coastal Lowcountry, please be sure to like, subscribe, and tap the bell for notifications so you'll be the first to know about the current market here. And if the Lowcountry looks like a place that you would like to call home, give us a call, shoot us a text, send us an email, or book a Zoom call, all in the description below. Again, this is Keith and Donna Hellman, hosts of the Coastal Lowcountry Real Estate Channel and Local Realtors. And it has been, as always, an absolute pleasure spending time with you again today.